The richest investor alive just moved $325 billion to cash, and most people have no idea what that means for their portfolio. Let's start with some context. Since Buffett took control of Berkshire Hathaway back in 1965, the stock has averaged roughly 20% returns annually. That's approximately double what the S&P 500 has delivered over the same period. We're talking about a cumulative return that dwarfs the broader market by an almost incomprehensible margin. So yeah, this guy knows a thing or two about navigating difficult markets. Now, here's the thing. Right now, we're in a market environment with some genuinely concerning signals. AI stocks are trading at record valuations. Nvidia alone is now worth more than every major bank in the US and Canada combined. The S&P 500 is more concentrated in a handful of companies than it was during the dot-com bubble, and private and government debt is climbing at an uncomfortable pace. So let's walk through what Buffett says we should actually do about it. The first piece of advice is to stop thinking about stocks as ticker symbols and start thinking about them as businesses. Buffett is remarkably consistent on this point. When you buy a share of stock, you're buying a small piece of a real company with real revenues, real products, and real employees. If you're just watching the price and trying to predict where it goes next, you're not investing, you're speculating. And speculation, especially in a highly leveraged market where borrowed money is inflating prices, can blow up fast. The practical takeaway here is to look for businesses that will hold up regardless of what the broader economy does. Think utilities, grocery chains, healthcare. These defensive sectors tend to weather downturns better precisely because people don't stop needing medicine or electricity when markets fall. The second principle Buffett emphasizes is staying within your circle of competence. He uses a brilliant analogy here. When cars first appeared, there were around 2,000 automobile companies. The car obviously changed civilization, but picking which three companies would survive out of 2,000 was nearly impossible if you didn't deeply understand the industry. Today's AI boom follows a similar pattern. Maybe AI reshapes the world. Probably it does. But knowing which companies will actually capture that value is a completely different question. Buffett's advice is straightforward. If you genuinely understand how a technology works and how specific companies are monetizing it, you can invest in it with confidence. If you're just riding the hype, you're setting yourself up for a painful lesson. Third, build a margin of safety into everything you buy. Buffett describes this using a bridge analogy that stuck with me. If you're driving a truck over a bridge rated for 10,000 pounds and your truck weighs 9,800 pounds, you might feel pretty comfortable if that bridge sits just a few feet off the ground. But if that same bridge crosses the Grand Canyon, you'd want a much bigger cushion. The same logic applies to stocks. The riskier the investment, the more discount you should demand before buying. And in a market where the S&P 500's price to earnings ratio has been sitting above 30, historically one of the most stretched valuations on record, that margin of safety matters more than ever. Fourth, and this one is beautifully counterintuitive, do less. Buffett has this thought experiment where he asks you to imagine getting a punch card with just 20 holes when you graduate. Every stock you ever buy uses one punch. Once they're gone, that's it. No more purchases ever. He argues we'd all make dramatically better decisions if we operated that way. There's even a well-known story from Fidelity, possibly apocryphal but instructive regardless, about a study that found their best performing investors were either people who completely forgot they had accounts or people who had passed away. Sometimes the best move is simply making a great decision and then leaving it alone for a very long time. So, what does all of this add up to? In a market showing signs of overvaluation, concentrated in a handful of companies, propped up in part by borrowed money, and populated by investors chasing short-term gains, Buffett's advice is almost radical in its simplicity. Buy businesses you understand, stay in your lane, demand a fair price, and then be patient enough to let compounding do its work. Markets will be volatile. They always are. But volatility is only dangerous if it forces you to make emotional decisions. And if you've done the work up front, if you know what you own and why you own it, you don't have to panic when things get bumpy. That's not just good investing advice for 2026. That's timeless wisdom from someone who has proven it works.